I'm going to show you how to build the discounted cash flow valuation for all the stocks that we've collected data for, about 2,700 stocks or so. So let's get to it. So the first thing you need to do is open up a fresh Excel workbook. Then we're going to go and save the file, so save as. Now, file hygiene once again. I want to save it in the investment market value model folder. And then I want to save it as a binary workbook. The pros of saving it as a binary workbook is it's about half the size of an XLSX file, that one. And you can put macros in it if you need to at a later stage. So the name is Inv301.02 DCF valuation of stocks V01 XLSB. Save it. Okay, so now we need to put in the data that we've pulled together with Python. So the file that we want, is this in the findat folder, the file called price eps.01 csv. Open that, and now you've got all these earnings and price data. So select all of that, copy all of that, and then here we go. You want to just paste it in. Fantastic. So let's just go to view and then freeze panes. Makes it nice and easy to work with. Some of these numbers look funny, so just select all of that and then format it. Push that comma sign and home. And let's just give this a name. Call it code. And save. Fantastic. So now the next thing that we want to do is calculate the growth. So let's just add in a column over here, just so we can label things, and we're going to call this growth rate. What's called earnings. Earnings growth rate. I'm going to call earnings 2, 3, 4, and 5. Because we only have you'll see the way the calculation works, why we're only using these years and not year one. And let's just give this a color, a nice, whatever that color is. Great, so the way this works is you go, that is equal to E2 minus E1, let's put that in a bracket. So we have the difference between the 2 years in earnings divided by E1. Okay, and that gives us a minus, so it's gone down by 23%. Now, just in case this gives us an error, we want to sort of put a error thing around it. So if error, open brackets, close bracket, and then comma 0. We want it to give us a 0 if it's an error. Okay, and then let's just format this as a percentage. Cool, and now just drag it across, and you can see the formula's gone across over there. So we have the growth rate for each year. Now select all of these, and then in the corner, double left click, copy it down. So you got some really, really wacky numbers. But there you go. There we go, down to the bottom. Next. Okay, so now we're going to just calculate what the average growth is. So, average growth. Let's just neaten up this heading. So, select the whole row, column, row 2, and click wrap text. Okay. Average growth, we just go equals average And then select the 4 numbers. Hey, you got your average, and let's just color this column. It's all part of the same thing. They've got some wacky numbers over here, but yeah. Now we want to add in another column above here. So insert. We want to adjust this growth. So we want to have conservative assumptions about this growth. We don't want to just take the growth figure as it is. So what we're going to do is we're going to put in a growth damper. And then we also want to put in an assumption to say what the maximum growth can be. So 630 or 142% is just ridiculous. So we have to put in what we think, what we will accept as the maximum growth the company can grow. So we need to put in an assumption for that. Max growth. So for both of those, let's just color this column. And let's just make it look nice. So if you click in borders, and put some borders there. The maximum growth we want to say is 15%. Earnings growing above 15% from 1 year to the next. I mean, that's the maximum that we'll take. And then secondly, how much we want to dampen the existing growth is by 60%. So we're taking conservative assumptions here to say this average growth figure, let's just make it a slightly lighter shade just so that you can see that it's a sort of total thing. We're going to say, we're going to call this column adjusted growth. Okay, and we in the first instance going to say that growth times by 60%, the dampening factor, and F4 anchors the Q1. Right, now we want to push the percentage sign, and we want to see 1 decimal. And let's just tidy that up. So that's the first thing. The second thing is we want to do a test to see if this is greater than 15%. So to do that, we go if, open bracket, and our logical test, so comma, comma, back, the logical test, if this P4 is greater, if absolute ABS P4, so the absolute value, which is always going to be positive, is greater than 15%, and we want to anchor that, so F4. If it's greater than 15%, we want it to return 15% as the max, anchor it, and then times 60%, and then anchor that, F4, enter. Okay, and then double click on the bottom right corner. So you can see all of these where it's greater than the 15%, it's just returning 9, which is 60% of 15. So there we go. First thing. Next, we need to calculate the average earnings. So over here, let's just label this. Average earnings. Let's just make that a little bit wider. And then just call this average earnings. Capital. Okay, and let's give this a different shade. Let's give it a blue. Now this is quite simple. This is just the 5 years worth of earnings with an average. So type in average in the formula bar and then just select these 5 and hey, we have earnings. Double click on the bottom right and goes all the way down. Next. So next we want to calculate the PE ratio. So we're going to call this PE ratio. And we're going to have to call this PE1, PE2. Select that, drag on the bottom right, 3, 4, 5. Fantastic. And let's just give this a color. That same shade. Now the PE is quite simply price, the price in year 1 divided by earnings in year 1. Hey. But we also want to, just in case we divide by 0, no problem there, or there's a blank, we just want to put an error trapping on it. So if error, open bracket, value of error 0. Drag this across and then double click. Here we go. We have the PE ratio. Next we want to calculate the average PE. So let's give this a shade. Here we go. So let's just put in our average. Equals average. Select those. Okay. Okay, everything seems okay. So the next thing we want to do is, in a similar way, we want a PE damper, just like the growth over here. We want a maximum PE that we will accept, and we want to dampen whatever the PE that is in here. So we're not going to just accept the sort of 17 or 27, and here 100. I mean, that's just ridiculous. So let's just put in the column adjusted average PE, color it in. Okay, and we want to call this PE threshold, and then above that PE damper. Okay, the PE threshold is 35, which is very, very high, but nothing above 35 we will accept as a PE, and then our threshold will be 60%. Okay, so now the way that works is equal to, you take the average multiplied by the damper and then F4 to lock it down with absolute referencing. Okay, and then we want to put a formula on it saying if absolute, so the absolute value of this average is greater than 35, then F4, comma, if it's greater, we want it to return 35 times by 60%. Lock it down. There we go. So the 65, this 40, this 101, they all have the same PE of 21. The maximum PE we end up with is 21 because of these two criteria. Let's just put some formatting around it. Okay. Next. So next we want to forecast the earnings. So forecast earnings. And let's call it year 1. Let's drag this. Year 5. Cool. So 5 years of earnings. So year 1 we're going to make equal to the average earnings. So there we go, 1.69, which is all of this. Average of 1.69. So that's year 1. Okay, and we got these negative numbers. So what we want to do, let's just first format this. Where we got these negative numbers, we either have a negative growth, we might either have these like negative growth rates or negative average earnings. If either of those are the case, we want it to just return 0. So let's just go if, and we're going to go bracket that, logical test. So if or, open brackets, close brackets, and the logical test is if average earnings is less than 0, or this growth rate is less than 0. Give me 0. So let's do this again. Bang! These zeros have disappeared. Save the file. So we've calculated forecast year 1 earnings by just taking average earnings, and then just in case it's a negative number, we then put an if statement on top of it to return a 0. So these subsequent years, we're going to use this adjusted growth rate to calculate what the following earnings are. So that is equal to, open brackets, we don't actually need the brackets, but hey, that's multiplied by open brackets, or bracket, 1 plus this percentage over here. And then function F4, F4, F4 again. We want just the $sign next to the Q, so we're anchoring just column Q. And drag this across to the right, and you'll see still looking at column Q, and it's looking at the previous year's earnings. So let's just format all of this again. So push the comma, 169, 173, 178, 182. So it grows by 2.5% a year. Okay. So double click. Hey, we now have forecast earnings. So the next thing we want to calculate is the terminal value. So in the previous video I had an explanation on that, so refer to that if you want to have a look. That is quite simply the year 5 earnings multiplied by the adjusted PE ratio. Bang, let's make it look nice. Format it, double click on the bottom right. Cool, we have terminal value.